Hey everybody, thanks for joining us. I've got November's safe investing update. It's amazing how quickly things have changed, and that's why I continue to do these safe investment updates. So let's jump into it. Interest rates. Interest rates have changed drastically over the last, say 6 months. So when we talk about interest rates, I think my last update, 10-year treasury was 2.8. Two-year treasury was 3.25. That's called an inversion, right? That's 0.4% higher interest rate to invest 8 years shorter period of time. That's the polar opposite of what we're used to. And that historically has always indicated a decline economically. But we're in weird economic times. So when we look at all this, that's the old rates. We jump into the rates today, and now we've got 3.8 on the 10-year and 4.4 on a 2-year, 4% on 2-year investments. That's pretty incredible. And the treasury rates have always been way behind bond rates. But again, I've talked about it. The market seems to push back on the Feds. They don't like the Feds pushing interest rates 0.75% every few months, and that's really important to understand. The Feds aren't directly changing anything other than the Fed's fund rate, which is an overnight rate. And when they push it up 0.75, it's not like it's a stagnant interest rate. They always say that they're trying to reach the level of 3.75 to 4, because when they push it up 0.75%, then the market kind of takes over. And then they push it up again, and then the market kind of takes over. And then they push it up again, and the market takes over. And so the interest rates aren't as cut and dry and clear. We try to run things on a market basis. And so yes, the Feds get to influence interest rates, but boy, they're pushing hard on these short-term interest rates, which have caused this conversion, which is now 0.6% off balance, right? The longer we invest, we should be making more money. Now we're getting paid to invest shorter periods of time. It's interesting. But that's the treasuries. So let's look at the rest of the world. Well, when we talk about corporate bonds, we hopefully know at this point, as interest rates rise, the value of your bonds go down. That's a huge problem for people that have continued to be stubborn and stayed in bonds. To be real honest, the best time to get out of bonds was about 2003. Interest rates plummeted to virtually zero, and bonds became worthless for the next 2 decades. Okay, that's the reality of where we are. We shouldn't have been in bonds. Bonds are not good when interest rates hit zero. There are plenty of other safe investment options out there. But now interest rates have bumped up. Now, in the grand scheme of things, we are still extremely low in interest rates. Our interest rates are still very, very low. So keep that into perspective. If you're locking into a longer-term bond, anything over 10 years, honestly, anything over 5 years, to be real honest, the reality is we're going to see a lot of fluctuating in interest rates, whether it's up or down. If interest rates go down, that's good for you as long as you sell. That's the weird thing about bonds. The stock market, if it goes up, that's great if you sell at the top. But if it comes right back down, it never went up as far as you're concerned. Well, bonds are the same way. If you own them and interest rates go down, then that's a good opportunity to sell them, especially in the world that we're in today. Because from 1982 to about 2003, interest rates in the United States were a ski slope. You could just continually ski straight down there. But now what we're doing is trying to raise them, falling apart, trying to raise them, fall apart, trying to raise them, fall apart, trying to raise them, fall apart. So all we're going to continue to see is volatility in interest rates. And that typically spells bad things for bonds. But I'll be real honest, it's really enticing to go buy bonds now. You're not seeing this in your bond mutual funds, but boy, you can go buy individual bonds and you can make 4 or 5%. There's even a 6% on a single A in that 10-year. So understand interest rates in the 10+ year range bonds are where that opportunity is. But I don't know that I'm comfortable locking in to bonds, which are exposed to inflation risk, right? Inflation goes up. Our Feds only have one tool, raise interest rates. Inflation, raise interest rate. Well, if your safe investment is bonds, it's a bad idea. So for retirees, not a big fan of this. Some of us in 401ks, things like that, we don't really have a choice. It's our only choice of a safe investment. I still try to avoid these as much as possible. But are there little places here and there that they might make sense? Well, at this interest rate, yeah, maybe a little bit here and there. But there's still better alternatives. And that better alternative is fixed annuities. I know everybody hates that word annuity, but if you actually took the time and open-mindedness to understand what these things are, this is where all the safe investing is going. We haven't seen stuff like this for over 20 years. This is great stuff, okay? We have to understand that these interest rates that they're offering are better than anything else on the market. So, guaranteed fixed rate time periods, just like a CD. This is literally a CD from an insurance company with a couple of things that are much better than CDs. First of all, these are all tax-deferred compound interest, except there's a couple of exceptions on the compound interest. They are all tax-deferred, and most of them are compound interest. Interest-only withdrawals up to 10% penalty-free withdrawals. Every company has their own parameters. Some are 5% withdrawal parameters. Some are you can just take the interest, and some you can take up to 10% of the money out without having to sell it at the market, without having to be exposed to any risk or fees at all. You can reach in and take up to 10% of the money out. They're always having higher rates than CDs. These things are going to beat the banks every day of the week. Typically, the vast majority of the companies out there do 3, 5, 7, and 10. So the 2-year, the 4-year, these other years there's very few carriers that actually provide those options. And yes, there are no fees and no risk, period. So you look at the interest rates in the fixed multi-year guarantee interest rate world. This is what we're dealing with. 2-year, you can make 4.3, 3-year, 5.3, 4-year, 5.4. The sweet spot typically in this world is the 5-year. 5-year, interest only, you can make 6. So here's the neat little niche that interest only gets you. If you planned on using this money, pulling it out every year, 6 is way better than 5.6. If you plan on leaving it in there and letting it grow, 5.6 is way better than 6. I know that sounds really weird, but the fact that this is compound interest and this is simple interest is the difference. So for those of you that actually plan on using the money, interest only is perfectly fine. Those of you that plan on leaving it in there and compounding the growth, you want that compound growth. And then from there, they just slide sideways. They don't get any better, right? 6, 7, 8, 9, 10. There's no reason to go do these at this point. There isn't. Okay? If you're going to go out that far, to be real honest, that's when you might want to consider bonds and look for that opportunity for when the world falls apart again and they drop interest rates and then sell those bonds. I don't recommend going out that far on fixed interest rates. The last time we had a rise in interest rates like this, we climbed the mountain all the way to 15+% interest rates. I'm not saying that's happening right now, but I want you to understand that is what we're dealing with. It is possible. I just don't think that our system can handle that with the amount of debt that we have out there. Okay? So we need to understand if we are looking for fixed rates for our own personal portfolio, the sweet spot's the 5-year fixed annuity, multi-year guarantee annuity. You can get simple interest at 6%. That's pretty fantastic. Come on now. Think about the returns in your portfolio. If you averaged 6%, you beat the stock market over the last 20 years. Stock market being, if we said the S&P 500. Believe it or not, the last 2 decades, that beats it, especially if you're withdrawing. And if you've watched a lot of my videos, you know the only people that need safe investments are those using their money, pulling it out. So 6% is a pretty great opportunity out there right now. 5.6 compound for those of you that just want something safe and stable and they're not pulling. That's the best thing out there right now. All right. So that's fixed annuities. Multi-year guarantee annuities, MYGAs is what they call them in the behind the scenes in the industry. And then the last safe investment that is by far the best thing I've seen out there since sliced cheese. I don't know. The reality is again, I get excited about this because I haven't seen safe investments this good forever. I haven't. We're talking over 20 years since they've had safe investments that were even remotely close to these. So first things first, great fixed rate and several indexing options. Okay, so here's the thing. We have a choice. A fixed indexed annuity is just like that MYGA, that multi-year guarantee annuity. Here it is right here. There's your multi-year guarantee annuity. They're guaranteeing 4% interest. 6 is better. You're right. Absolutely. If you just want a fixed rate, that's the way you go. But here's the coolest thing. This company, all these fixed indexed annuities, allow you to choose how to earn interest each year. And they give you indexing options. And all this is a stock index tied to math. And every year on your anniversary, they do the math based on how the stock index did, and they pay you the interest they owe you. So in this example here, you have the S&P, Standard & Poor's Multi-Asset Index. And they are willing to pay you a 170% of whatever that stock index does, annual point to point. So anniversary to anniversary, if that stock index is up, they're paying you 170% of whatever that index does, more than what that stock index does. Okay, that's because your money is not invested in that stock index or in the stock market at all, for that matter. Okay, that's important for us to understand. They go out, do corporate lending, and then they hedge, they buy options to buy that stock index in case it goes up. So they buy these options. If the market skyrockets, they get to buy the index at this price, turn around and sell it the next day at this price and make a huge profit. And all they have to do is forward that on to you. So they have no risk. So when the markets aren't doing well, you can't lose. By regulation, you're not allowed to lose. When it goes up, they have to pay you 170% of whatever that stock index does. Okay, so good times are great. Bad times aren't bad. You make zero when the market goes down. Okay, so this is real. These are real earnings right here. And the coolest thing about this is you get to choose how to earn interest every year. You can tie it to the S&P one year. You could put 40% in the S&P, 60% in the fixed rate. A lot of these portfolios, you think about it, people are putting, 60% in stocks, 40% in bonds. Well, you can do that here. And I actually prefer to just pull up my handy dandy little spreadsheet here and show it to you. Here's the S&P 500, okay, $100,000 investment. Well, market goes straight down for a while, and then it goes up, and then it goes down, and then it goes straight up. 2 decades are pretty interesting. We've got a decade of straight up. 2010 through 2020 was a straight up decade. And then you've got the flounder sideways decade. You've got 9/11 happening and 2008 happening. Great example of how your portfolio is going to perform if it's 100% in the S&P 500 with no withdrawals. 100,000 turned into 364. But in the fixed indexed annuity world, we could put 60% in the indexing and 40% in the fixed rate, and look what happens. We earn 1%, 10, 12, 6, 4, 6, 10. Even when 2008 happened, we earned because we had some money in that fixed rate. We were just going to earn a fixed rate. Okay. So what's nice is we're averaging a great growth, and we actually beat the market, and we had no risk and no fees. Okay, it's important we understand this is a safe investment. By regulation, there's no risk and no fees in this thing. Yes, historically, the last 2 decades, we beat the market in these things because we never had to make up from the losses. We didn't have to make up from when 9/11 happened. We didn't have to make up from when 2008 happened. We didn't have to make up for when the end of the year crash in 2018. We didn't have to go through the roller coaster in the pandemic. We didn't have to make up for any of those bad years in the market. And it just kept marching along. But here's the thing that I really tell people they need to understand. Again, the only people that need safe investments, the operative word there is need. The only people that need safe investments are the ones withdrawing. Look at the chart here. This is the S&P 500 performance on 100,000 investment, and this is the fixed indexed annuity, the blue line. Watch what happens when I do a 4% withdrawal rate. 4% withdrawal rate. All of a sudden, every year, we're going to pull 4% out. Look what happens. This is what's so important for us to understand, and this is why we need safe investments. Those of you that don't withdraw money from your portfolio, you don't need safe investments. Those of you that do, the S&P 500, the stock market in general is very inefficient. Withdrawing from losses, withdrawing from turbulence is a terrible idea, right? So we need to have investments like this when we need to withdraw, because we eliminate those losses and the performance of the portfolio is astronomically better consistently through any period of time. Okay, we need to understand that. So that's why we use these fixed indexed annuities. We use them as safe investments for people that need a safe place to withdraw from. It doesn't mean you put all your money in these things. It means you replace that bond allocation to these things. The safe investing world, to be real honest, has never seen a better safe investment. This is by far the most efficient safe investment for people, especially in their retirement years, trying to withdraw money from their portfolio. We can change with the times. We can adjust the portfolio. We can add more fixed rate. We can add more stock market exposure, and we have no risk along the way, and we have no fees along the way. It's so important. And for the most part, you have 10% access to these accounts almost universally across this world. You have 10% access to the account. So in this case, you could take 10% of whatever the value is each year. And it refreshes on your anniversary. So you can take 10% this year, your anniversary hits, you can take 10% the next year. Most of these, 100% goes to, or 100% accessible if you're confined to a long-term care facility. And yes, 100% of the full cash value goes straight to your heirs if you pass away. There are no fees, there's no risk. And again, this is really ideal for people, especially in those required minimum distribution years or heading to that. When they're pulling from their IRA, this would be an investment in the IRA, just like a stock, just like a bond. That's how we use these. And they are by far the most efficient, safe investment out there for people that need to withdraw their money. Hopefully that helps. There's a handful of choices out there. Believe it or not, there's a 5-year version of this and a 10-year version of this. And the interest rates and participation rates are guaranteed for the whole term. And because they're guaranteed for the whole term, to be real honest, I actually like the 10-year over the 5-year because the 10-year is guaranteeing the participation rates, not just a stagnant fixed rate. I don't like stagnant fixed rates locked in for 10 years, but in indexing, performance of a stock market, I get paid the math. That math is locked in for the whole term. That's pretty fantastic. All right. Let me know if I can help out in any way. Hopefully this gives you an idea of what's going on in the safe investment world. The fixed rates are pretty fantastic out there. I don't mind 5-year fixed rates, especially when you can hit, what was it, 5.6% on a compound return and 6% on a simple interest. Guaranteed, no risk. Markets can go up and down. Interest rates can go up and down. You have no risk. That's what you need in your portfolio. Eliminate those bonds. Those bonds don't make sense. You've got to invest for today going forward. And that means if you didn't get out of bonds when you should still be getting out of bonds. There's better choices out there. If we can help in any way, fantastic. I've got all my previous months safe investing updates. You can go back and look at the differences in the interest rates. It's kind of fun to see how quickly we've risen. And that's why I'm doing these. As long as we see this volatility and changes in the market, I'm going to keep giving you updates in these safe investment choices that we have out there. Give us a call if we can help out in any way. I'm sure there's some free reports and wonderful stuff down below, but more importantly, share this with your friends and subscribe to our page and give us comments below. We love comments. Send us questions. If you know something else out there, send me some information. I'd love to see it. And everybody needs to have a wonderful week, and we will see you next month.